Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront and generate consistent returns year on year. So the first thing you want to do is open up your brokerage platform, and then you want to navigate to just any equities underlying and pull up a list of expiration dates for that underlying. At this point, we want to simply see where we are in the option cycle and lock in an expiration date that we're going to choose to mock up our positions on. So the expiration date that we choose needs to be between 30 and 60 days out in time, 45 days ideally. However, it also needs to be a monthly expiration and not a weekly or quarterly expiration. So the only expiration date that fits that criteria currently is December 20th. We've still got 35 days left on the clock. Um, and that's the one we're going to go for. That's the most suitable one from the choices that we have available. So we could take the information, 35 days, come over to our watch list, and simply filter out anything that has earnings over the next 35 days. And the reason for this is simply because we do not want earnings to come along and disrupt our trade. Earnings will increase volatility, it will mess up our deltas, and ultimately these things will have a negative effect on your P&L. After doing that, we also want to then remove anything with a low liquidity rating level. And the reason for that is because we only want to trade liquid underlyings as they have tight spreads and are easy to get in and out of. Now you'll be left with a watch list that looks something like this. And it's just personal preference at this point, but I like to sort everything from high to low IVR. Some people like to do it from biggest percentage change. I like to use IVR. And the aim here is you want to find an underlying that will fit well in our portfolio that has a nice high IV rank with a healthy IV level, IV percentage level. So IV rank and actual IV are two different things. We want to sell premium when implied volatility is high, and then we can play the contraction of volatility back down to the mean. Why do we do this? Because volatility is mean reverting. So keep in mind of what's already in your portfolio. If you're heavy in any one sector, don't go with that sector. Choose a different sector, so on and so forth. So, with that being said, let's go down the list. We're just going to assume that you don't have anything in your portfolio right now, so you can choose anything you like. Anything with an IV rank of over 50 can be considered high. Anything below 50 can be considered low. Sometimes anything above 30 can be considered high. So we just go down the list and we want to look at the size of the underlying, i.e., the price that is trading at. That will play a factor into um, the kind of positions that you can place, the kind of positions that you can open. I'm having a look here at SMH with an IV rank of 40.3, and it's got a fairly healthy absolute IV level of 35.6. And it's currently trading at $241, just over $241, sorry. I think SMH, we can have a look at that. SMH is usually quite nice. It is an ETF. ETFs are nice to trade because we don't have company risk to worry about. And we already know which expiration date we're going to choose, which is December 20th. And now we can pull up the options chain for December 20th. And this is what we are presented with. So this vertical orange bar here shows you what the expected move is of SMH over the next 35 days. The horizontal orange bar shows you where price currently is with respect to the strikes. And these dotted blue lines show us where our standard deviation levels are. So the first blue line from the current price is just the one standard deviation mark, and then the second one is the second standard deviation mark, and so on and so forth. So we want to sell one call and one put as we always do, and we want to sell them between 15 and 20 deltas. And if you notice, 15 and 20 deltas usually will put us around the one standard deviation mark. As we can see here, the 15 delta is at the 270 strike, the 20 delta is at the 265 strike. We can go with either one. Let's just be conservative and go with the 270, just outside the one standard deviation mark. And on the put side, we've got a 14 delta and an 18 delta. I think we can, because we were a bit conservative on the call side, we can just go a little bit heavier on the put side. We're still outside of the expected move, so we can sell a contract here at the 19 delta. Um, and if you didn't necessarily want to be worry about being too conservative, by all means, you can just go with the 265 strike on the call side, 20 delta on the call, 19 delta on the put. Um, you will collect more premium, and to be fair, I actually would recommend this as opposed to the 270 strike. 20 delta is absolutely fine. We've got a probability of profit of 70%. In actual reality, that will end up being closer to 80%. We've got an 80 to 85% probability of hitting 50% of max profit at some point over the next 35 days. Again, this is probably closer to about 93% in reality. We'd get $20 of daily theta decay. We'd collect $547 upfront in premium, and our broker would require just under 2.7k to open this position. So a very, very nice return on capital for a naked position. I understand if 2.7k is too much for your account, you can simply just buy another contract a little bit further out, and that will limit your loss. So you no longer have an unlimited loss potential. Your loss is now limited to the difference between the two strikes minus the premium that you collect up front. So we'd now collect about $1.50 times 100, because there's 100 shares per contract. So about $152 up front is what we would collect, and our max risk would be 348. And our broker knows that our risk is now defined, so it's only going to require um, what our max risk is in buying power, which is $348, which is a lot less than what was required with the naked position. So that's how you can find and manipulate positions. If you wanted to, if $348 was too small, you can just move your long further out. So now our max risk is higher. The spread is not $5 anymore. It's $10. The premium is more, so it's $10 minus 260. So our max loss is now 740. And you can literally just play around with this position and manipulate it to however you want to fit inside your portfolio. If you are wondering how much buying power should you be allocating to your positions, well, to solve that problem, we've come up with a position sizing template that's free for everybody to use and get a hold of. The link is in the description. The way it works is you enter in the size of your portfolio at the top, and then you enter in what the current VIX level is below, and then everything below that will then be automatically calculated for you. And as long as you follow this spreadsheet, this template for your portfolio, you'll be absolutely fine over the long term. To get a copy, link is in the description. Click on free position sizing template. If you want to learn in more detail, again, link in description. This time, click on EDS Premium and get yourself signed up. Inside, you will have access to our portfolios that will allow you to see exactly what positions we're placing, how we are managing risk, all the adjustments that we're making, etc., all in real time. There is also a full course inside, so no prior knowledge is required. We will teach you everything that you need to know. And it's also a private community. So if you get stuck, you can speak with myself directly, or you can speak with other like-minded individuals. There's a 100% money back guarantee. So once you have studied the full course and followed our trades for at least 6 months, if at that point you haven't been profitable, then we will work for you for free until you are, or you can simply request a full refund. So it's completely risk-free on your part, and it is £1 a month to join right now. The price will be increasing. However, once you're in, the price is locked in for you for life. So with that being said, I will see you guys on the inside.